Well, as the market is digesting the latest economic data, we are approaching the 2-year anniversary of the bull market. So how could the health of the consumer impact market momentum going forward? For more on this, we've got Matthew Palazzolo. He is a senior investment strategist over at Bernstein Private Wealth Management. Matthew, it's great to have you on here. So as we're getting in this consumer sentiment data, a feeling out there that inflation is going to be higher for longer, how big of a risk would that be, if true, to this bull market rally?
Look, I certainly think that is a risk. Inflation and what that means ultimately for what the Fed does on monetary policy is probably one of the biggest risks that we see to this bull market continuing. Absent any surprises to the upside over further months and quarters, it's our expectation that the Federal Reserve will continue to cut rates throughout the rest of this year into 2025 and probably get the Fed funds rate down to about 3%, which would be a fairly conducive environment for equity investors. So it's our expectation the bull market continues into next year, but that the returns for equity investors probably are more modest than they have been over the last couple of years.
So maybe it won't necessarily be a repeat of what we have seen, those massive gains to the upside. Matthew, I think a lot of investors are trying to figure out what that leadership is going to look like, right? How much of a rotation we're going to see maybe out of these larger cap tech names, which sectors are best positioned at this point. How are you adjusting your portfolio then potentially for this next leg of the bull market?
Yeah, so I think we're certainly encouraged by the results in the third quarter. If you were to look at the returns across the S&P 500, there was much broader participation than there was over the previous quarters or even the previous couple of years. So that has allowed us to gain a little bit more confidence in our positioning. We tend to be very, very diversified investors, owning not just the top leadership names, but also those across the board where we find either undervalued opportunities or companies that maybe haven't been in the sights of broader investors. So we're thinking that we're going to continue to see more leadership out of the rest of the index. And if you look at valuations, that's supportive of that. The leadership that you've seen over the last couple of years, those companies are fairly expensive, and so we're seeing less expensive, more opportunity further down the line, and I think that continues like we saw in the third quarter into 2025.
Matthew, you sound like Jamie Dimon this morning a little bit. He talked about how market levels are slightly inflated and markets, sadly, they don't stay high forever. What are your thoughts?
Again, if you look at the S&P 500 in aggregate, we're trading north of 22 times forward earnings, which at least historically has been at the upper end of the range, but for bubble territory. But if you were to exclude those top companies, the Magnificent Seven or the top 10 names in the S&P 500, the market is not as expensive. And so, it's hard to look in aggregate. Again, the companies that are beyond those top leaders in the index are more in line with their long-term average. That being said, we're not expecting much more valuation expansion over the next 12 to 15 months. We think the major driver of equity market returns is really going to come down to earnings growth. Consensus earnings growth next year is for something like 10%, which we think is probably a tad bit optimistic. We're expecting something more like 6 to 7%. And so if you get no movement in PE multiples and the market just moves on earnings growth, you're looking at something like a mid-single digit return, which again, after 2023 and 2024, that's not so bad.
Matthew, how much does the Fed's policy play into this? And when we talk about the fact that we could see delays here in the rate cutting cycle, there's lots of focus on November, but looking out into 2025, how much is that really going to potentially weigh on earnings growth that we could see, especially next year?
I think once you move past an exogenous shock, which again can't be forecasted at all, the monetary policy and a policy error really does, in our mind, ends up being the number one risk. If the Federal Reserve stays at a level that is restrictive for too long, unnecessarily, given where the economy is, then I think that is the number one risk that could bring valuations down, cause a somewhat meaningful sell-off in the stock market, and probably more acutely hit the economy and the consumer and the unemployment rate. So again, once we get past an exogenous shock, then I think the policy error from the Federal Reserve sticking around too long at a restrictive policy is what keeps us up at night.
So some cautious optimism there, Matthew, but I am curious, given that we are approaching this 2-year anniversary of the bull market here that's really been riding on the coattails of AI. Then we had a lot of questions about the validity of the AI rally. How much is the continuation of this bull market dependent on the AI story continuing to stay intact?
I think in the near term or over the next year or so, it's not dependent on the AI story continuing to bear as much fruit as it has over the last 12 to 18 months or so. Longer term, we certainly think that artificial intelligence is going to benefit the broad swath of economies, not just the technology leaders. And so that'll have benefits to productivity, to GDP growth, to top line and bottom line. So we are optimistic about AI, but not necessarily that it's going to continue to be the main story or the only story through 2025.
All right, Matthew Palazzolo, great to have you here. Thanks so much for joining us. Bernstein's Private Wealth Management Senior Investment Strategist. Thanks, Matthew.
My pleasure.